Think of an expanding business like an active manufacturing line. As long as the inputs keep flowing, it runs beautifully. But if that continuous supply of capital runs completely dry, everything stops instantly. That lifeblood is business finance. It is the money required to start, operate, survive, and expand any commercial venture. You need it to buy raw materials, pay salaries, and keep the lights on. When cash gets tight, the immediate temptation is to grab any money you can get your hands on. But taking capital without a strategy is the fastest way to bankrupt your company or lose control of it entirely. Align funding to the exact timeline of the business need. Short-term needs, under 1 year, provide working capital for daily operations and inventory. Medium and long-term funds, spanning 1 to 5+ years, cover multi-year investments like heavy machinery or building out a physical facility. Choosing the wrong branch on this timeline creates a structural flaw. If you fund a 10-year factory build with a 6-month loan, you mathematically guarantee a cash crisis that forces you to either surrender operational control or face failure. Consider a scenario where you face a gap of under 1 year. The business needs immediate working capital just to process incoming orders. This matrix breaks down your short-term options. First is trade credit. By negotiating supplier terms, you acquire necessary inventory immediately without an upfront cash payment. The trade-off is the narrow repayment window. By delaying payment, you forfeit early payment cash discounts. An alternative is factoring. If you have money tied up in accounts receivable, you sell those unpaid customer invoices to a financial institution to generate immediate cash flow. The catch is the cost. The institution charges high service fees. Then there is commercial paper. This allows a business to issue notes and access unsecured, short-term money at borrowing costs lower than traditional bank rates. But it has a strict requirement. It is exclusively reserved for highly reputed, financially stable companies. Short-term finance keeps the lights on during a crisis, but whether through lost discounts or direct fees, you pay for that survival directly out of your immediate profit margins. When you shift from surviving the month to long-term expansion, you can take the ownership route, where funding is tied to the equity of the business. This chart plots financial risk against the loss of control. In the bottom left, we have retained earnings, the portion of profit kept in the business. It is the cheapest source of long-term finance because it is generated internally with zero repayment obligations. The limitation is scale. Relying solely on your own earnings reduces the dividends you can pay out and bottlenecks the speed of expansion. You can only grow as fast as you profit. Issuing equity shares solves the scale problem. It secures massive, permanent external capital that never requires mandatory repayment or compulsory dividends. The cost is the permanent dilution of your voting control. You are giving outsiders a residual claim on all future assets. Preference shares sit in the middle. This raises capital with fixed dividends for investors, usually without diluting your core voting control. But preference shares create a specific financial burden. The dividends are not tax-deductible, and they must be paid out before your regular equity holders see anything. The ownership route protects you from bankruptcy because there is no required debt service. However, it forces you to permanently surrender a slice of your corporate sovereignty. If you refuse to give up any ownership, you have to look at the alternative for long-term growth, the debt route. Look at the bottom right. Issuing debentures or securing term loans allows you to retain 100% control while gaining significant tax benefits on the interest you pay. But rigid structures are vulnerable. Debt requires mandatory fixed interest payments. If revenues experience a downturn, those unchanged payments can quickly destroy a struggling business. At the extreme edge are international sources, like global and American depository receipts. These tools unlock massive pools of foreign capital for expansion. Taking international funds exposes you to foreign exchange risk, complex cross-border regulations, and expensive issuance procedures. The debt route allows you to keep the financial upside of your success, but it punishes you if your growth stalls and you cannot meet those fixed obligations. The logic across all these scenarios is consistent. You must match the lifespan of the financing to the lifespan of the asset being purchased. This maps to 3 distinct paths. For the control-conscious bootstrapper, rely on internal retained earnings and trade credit. Avoiding equity dilution and heavy loans keeps you in the driver's seat. For the stable operator with predictable cash flow, borrowed funds like debentures are often the best fit. You can leverage your steady profits to cover interest while keeping full ownership. Finally, the high-growth startup should pursue equity shares and international sources. In this scenario, you accept a smaller slice of ownership in exchange for the capital required to build a significantly larger company. Capital isn't free. You pay for it with either your cash flow or your sovereignty. The right choice is the one that aligns your current scale and risk tolerance with your actual business timeline.